Hey everybody, I hope you're all doing well. Today's topic is risk management. This is one of the most important aspects to being a successful long-term trader, okay? This is one of the most overlooked topics within the trading industry, and so it's really important that we go over this in detail today. Now, I'm pulling up the Currency Pros ebook because we do have a page dedicated to risk management. Now, the reason it's only one page in the whole book before moving on to another topic is because it's actually a very straightforward process and there's not that much to it. You just have to be disciplined with it, that's all. But the actual theory of it is quite simple. Now this video is going to be a bit longer because I do want to jump into an actual backtesting session to demonstrate proper risk management. But in the theory section of this video, it's quite simple. I just want to go over a few of the main points within this little excerpt of the Currency Pros ebook, and then we'll move on from there. So basically, I want to focus on this section first. Let me go over some of the things I wrote here. So the internet can be a very toxic place for a trader. Everywhere you look, there are mentors and gurus influencing others to risk obscene amounts of capital per trade by participating in account flip challenges or simply portraying a lifestyle that causes others to be impatient and neglect the process of becoming a skilled trader. Now, these unhealthy practices can potentially lead you down a negative path. No successful and disciplined trader, and I repeat, no successful and disciplined trader will ever tell you that it's okay to risk more than 1 to 2% of capital per trade. In fact, most traders with large capital, and especially funded capital with prop firms, most traders are more than happy just risking 0.5% of their capital per trade, okay? This is the only way that we can remain profitable long-term and withstand losing streaks as well as uncertain market conditions. Because let me tell you, losing streaks are inevitable no matter what strategy you're utilizing, okay? I know that our strategy has amazing potential, huge risk-reward ratios, pretty healthy win rates as well. But you know what? Losing streaks, they aren't even always about the strategy themselves. Sometimes it's about the trader, okay? If you're going through tough times in your own personal life, that can sometimes really affect your trading. You know, if you're dealing with a loss in your family or some sort of constraints or, schedule issues, like time constraints, something like that, that can actually really affect your psychology with trading and can induce a losing streak, basically. So no trading strategy is immune to this. It happens to the best of us, even the most experienced traders who have been trading for 5 to 10 years or more. They all incur losing streaks. So the only way to really truly protect yourself long term is to practice proper risk management. Now, in the section at the top of this paragraph where I'm mentioning, gurus and influencers influencing people to risk crazy amounts of capital, you know exactly who I'm talking about. There's quite a few of them. I'm not going to name any names, but they're all over YouTube. They're all over Instagram doing these ridiculous account flip challenges. I have personally I've personally had one-on-one coaching sessions with traders who have taken courses and been quote unquote mentored by some of these people. Again, I'm not going to name any names, but one in particular, one of the most popular on social media, from what I've heard from other students of his, he's going around telling people that even risking like 6 to 7% per trade is not enough and you should aim higher and aim higher and aim higher. That's just gambling. That's a gambling mentality, because if you incur even a small losing streak, even like 3 to 4 trades, you are drastically affecting your account. And it's really hard to recover from that. So what I recommend, the safest and easiest rule to stick to, is risking just 1% of capital per trade. That's it. It's a very simple rule. And to be honest, if you're going after funding with a prop firm, I would probably recommend 0.5%. Because again, with the power of this strategy, that's totally fine to risk that amount of money per trade, because our risk reward ratios are so massive with the precision-based strategy that we utilize that risking small amounts of money doesn't really matter. I would maybe understand a little bit more if our average risk reward ratio is like, 1 to 2 or 1 to 3, something like that. Then you might be inclined to risk a little more capital because you're seeing slow progress. I can understand that. But given the strategy that we're teaching within this course and this ebook as well, there is absolutely no excuse to risk more than 1% of capital per trade. It's just not necessary. So like I said, combine this strict rule with high risk to reward trades and you will be unstoppable. The only factor to consider with this rule is that when you are trading correlated currency pairs together, you must lower your risk even further. So for example, if you're buying USD CAD while simultaneously selling Euro USD, it would be wise to split your 1% risk to two positions of 0.5%, okay? The reason being, both of these currency pairs are tied to the US dollar, right? So if your bias on the US dollar turns out to be wrong, both positions will most likely suffer. In the event that both trades are losses, you still end up with a total loss of 1% of your trading capital, rather than 2% if you were to risk 1% on each trade, right? So that's the general rule of thumb. If you're trading correlated pairs that involve the same currency, for example, the US dollar in both of these pairs, trade 0.5% of capital on each trade rather than 1% totaling 2% capital, right? Because then if both of them lose, you only overall lost 1% of your capital. So very easy to recover from. Now, risk management is simple. Don't overthink it. Treat it like a business and protect your capital as best as you can. I can't stress this enough. Capital protection is everything. If that's your focus, protecting your capital and being mindful of your exposure in the market, then money is simply a byproduct of that. Like the profit is simply a byproduct of that disciplined thinking, as long as your strategy is on point as well. So it's extremely important to practice risk management. Over leveraging and over trading and revenge trading are a quick path to blowing your trading account. If you don't ever want to blow a trading account and be part of that statistic, simply read this, watch this video again, however many times you want, take notes, whatever you have to do. This is how you prevent blowing a trading account, okay? So now that we've gone over that, I'd like to head over to the charts and dive into a backtesting session to truly demonstrate the power of risk management and risking 1% of capital per trade. Let's get started. All right, so we're taking a look at GBP USD. I'm currently on the 5-minute time frame, and I've located a refined demand zone, okay? So I'm anticipating price to react further from this demand zone and trade higher. Now, full disclosure, I'm on the replay mode. None of these trades that we're about to go through were cherry-picked in any sort of way. This is a genuine backtesting session. We're going to be going through everything together. All I know about this chart right now is that price does trade higher, but that's all I know. As far as entries go, that's going to be 100% genuine. We're going to go through that together right now. So, like I said, I'm on the 5-minute time frame, located a refined demand zone. We have bullish order flow on the higher time frame as well, so I am certainly looking for a long bias. So we've had an initial reaction to this demand zone, and I'm going to drop down on the 1-minute time frame for continuation executions, okay? So right off the bat, we've already got a minor break of structure. Let's map that out. Let's delete that, get that out of the way. All right, so we've got a minor break of structure. Can we trade off of this? Yes, we certainly can. Is it a little bit risky? Yes, it certainly is. Typically, what we'd want to see is, well, this is a new structure, right? So we'd want to see a pullback and then a break of that structure, and then another pullback, and this would be our really highly anticipated entry zone, okay? But we still can trade from the minor break of structure. And, just for the purpose of this video, let's go ahead and do that. So where can we identify that the last point of demand is that caused this minor break of structure? Let's get out the box tool. So my eyes are immediately drawn to this general zone of consolidation, these few candles here. the small candles right before the bullish impulsive move. Let's actually refine that a little bit to that last bearish candle. And we'll cover the wick of that bullish candle too, that very small wick. Okay, so we've got a nice zone there. Let's drag it out a bit. This would be an entry zone. Reason being, just to clarify, this is the last point of demand before the impulsive move to the upside that created a minor break of structure. All right. And this move also created pretty significant imbalance. So there's a high probability the price is going to retrace back to this level. Let's go ahead and place a buy limit order on it. Now, oftentimes you'll see me targeting the 50% of my point of interest, but when I'm on the 1 minute time frame, oftentimes I'll just target, well, in this case, since we're going bullish, the high of the zone that I have mapped out. Okay, if it was a higher time frame, such as possibly the 5 minute or more likely the 15 minute, then if I was taking a risk entry on those time frames, I would certainly be targeting the 50% because that would allow me a better risk to reward ratio. But like I said, on the 1 minute time frame, oftentimes those trades don't get triggered if you're targeting the 50%. So in this case, I will be targeting the entire zone. Let's keep it to a nice 3 pip stop loss. And in terms of target, if we're anticipating bullish order flow, this is the most recent major swing high. So I'm going to be targeting that. Whether that's going to play out or not, I have no idea. So we'll see. As you can see, huge risk reward potential. And this entire backtesting session is about risk management, right? So keep that in mind while we're going through this backtesting session. Okay, let's play price forward and see if we get tapped into this trade. Okay, so we're definitely tapped into the trade. Let's move the position over and play it forward and see what happens. Okay, looking good so far. That's a very weak break of structure, but let's keep going and see what happens. Okay, so we do get a pullback. Are we going to get stopped out? Still in the trade. Not looking too good so far, but let's see how this one develops. All right, let's speed this up a little bit. Okay, still in the trade. Now we have a proper break of structure. So let's map that out. Now we did come very close to getting stopped out here. Probably just like 1 pip of room there, maybe a little more. Hard to say what the cause of that was. I mean, we do have a wick here. And of course, on lower time frames, such as the 30-second or the 15-second, there would be more going on within this candle as well. I'm choosing to stick to the 1 minute time frame. I never go below that. So it is what it is, right? But we're still in the trade. We have the minor break of structure and then the second actual break of structure. So things are looking good so far. I was taking a look to see if there's any scale-in opportunities, but in my mind, there's nothing very clean here. Some might look at this candle as a point of interest, but I don't really like that. I prefer to see an engulfing candle. So if the bullish candle was engulfing the bearish candle, that would be more of a point of interest to me because it would show that volume really played a part in that move. This doesn't look too clean, so let's just continue to play price forward given our current position. Okay, so we traded back down quite a bit again. Okay, broke structure again. So order flow is still healthy. We're still in this trade. Let's see, any scale-in opportunities here? I would consider this a good scale-in opportunity, covering both wicks of the bearish and bullish candle. However, on this one, as you can see, the zone is so much bigger, almost double the size of this original zone that I had mapped out. So in this case, I most likely would target the 50%. Stop loss just below the zone, let's say 3 pips again, and we can target the same high for our take profit level, okay? Let's see what happens here. Whoa, okay. Gonna delete this one then. There's probably no chance of that coming back. Okay, so obviously our initial position here has hit the take profit, the full take profit for 11.57. So let's, where's my text box here? Okay, let's start documenting these. What was it? 11.57. Okay. So we're going to keep a little log on the side here. And this is the whole purpose of the video, right? We're calculating all the risk to reward potential out of an entire bullish leg, or somewhat of a bullish leg. We're going to probably take some losses, probably some break evens. We'll see how it goes. And we're going to see how our risk to reward ratio and our risk management plays a part in this. Okay, so the general rule of thumb is keeping 1% risk per trade. So that's exactly what we're going to do. So if you were risking 1%, then 11.57R would be 11.57% gain on your account. And if you take a loss, it would be a 1% loss, right? So pretty straightforward. Let's keep it going. So with this huge injection of volume into the market, we obviously have a very clear POI for a trading opportunity. I'm going to go with this bearish candle and the wick, the bottom wick of the bullish candle. Let's drag that over. And I would be targeting the 50% of this zone because it is a bigger zone, just like I mentioned previously. Let's see what kind of stop loss we can get here. Yeah, we can comfortably get a 3 pip stop loss. I'm happy with that. And as for target, this looks like it's a solidified high. So let's delete this ray line and we'll drag our profit to that high because we're looking for bullish order flow to continue. So we want to at least see that high be met, if not taken out, okay? So that would be the profit target for this trade. Now, as I'm looking at this, one thing to keep in mind is that we have relative equal lows right here, which could represent liquidity resting underneath it in the form of stop loss orders, similar to us right here, okay? So this is a bit of a risk. As you can see, our stop loss is just below these relative equal lows. So there is certainly a chance that when price makes its way back down, it'll tap us in, of course, but then there is a chance and a risk that we're gonna take that price will trade a little further to purge liquidity, okay? Now this is the 1 minute time frame. So this is in real time, this would be very fast paced executions. It's a risk that I'm gonna take for the purpose of this video. I don't know how it's gonna turn out, but we'll see. And I will also, just in case we do get induced into our stop loss in that area, I'm gonna keep this zone here as well, because if the first one fails, I'd be happy to enter again off the 50% of this second zone. So we'll see if we get our stop loss induced on this trade. Let's see what happens here. Okay, so this is definitely a solidified high. As you can see, we've had a huge pullback. Minor reaction to the hidden demand right here. Hidden demand meaning the wicks, because on a smaller time frame, those would show up as actual candles instead of wicks. Small reaction there, pullback. I mean, if you're really experienced, you could be trading these supply levels as well to short the market, but for the purpose of this video, we're just going to be focusing on long positions. Let's continue to play price. See, that would have been beautiful. That would have been a beautiful short position. Just beautifully tapped into that, started trading away from it. If we went short to trade into our next demand level, that probably would have worked out, yeah, very nicely. Very nicely. Let me just throw that on there just so you can visualize it, but then I'll take it off because it's not a trade that I took in this video, obviously. Could have gotten away with a 5 pip stop loss just above that high. Now, if you were targeting the demand zone that we were anticipating, That would have been a nice 5.68%. Beautiful trade. Anyways, we're not focusing on that. We're focusing on this. Now, this is interesting. Depending on what broker you're with, most likely, most brokers, this would have been a stop loss being hit. That is very, very close there. Maybe on FTMO or IC markets, that would have been enough to keep you in the trade. But for most brokers, for most people trading, that would have been a stop loss. So for the sake of this video, we're going to count that as a loss. Got to keep things real. Okay, so minus 1R. Let me shrink this so it's just kind of out of the way. Now let's see where we can get in next. I'm curious to see if price is going to make its way down and violate that zone completely and then trade off of this zone here. We'll see what happens. Okay, minor break of structure here, but I'm not really going to map it out because so far supply is still in control. So we could simply be reacting to this supply zone right now. Let me go ahead and delete this too, get that out of the way. Let's see if supply remains in control or if that zone gets violated. If this zone gets violated to the upside, I'll be looking for buys once more. And it does. So now this is a flip zone as well, right? Because we traded in, tapped into it, pulled away, and then broke structure, okay? So that is a valid flip zone, which means I'm gonna map it out as a flip zone. Let's see. This is interesting. So technically the last low momentum candle is this small bullish candle. I did mention previously how I would prefer to see my point of interest as a bullish engulfing in a long scenario. So this certainly doesn't engulf the previous bearish candle, but this is still a valid flip zone because of the reasons that I just mentioned. So like it was a supply and it flipped to demand, and this was the reaction point right here. So the area that's responsible for that reaction, I'm going to include the bearish and bullish candle as a whole. And to make things safer and give a better risk reward, I'm going to target the 50%. Stop loss placement here is a little tricky because of all these wicks, but I'm going to go with 3 pips because mainly I'm focused on this zone, right? I'm not really focused on this. This is very messy. It's also very efficient price action because everything's meeting together. We do have a little bit of imbalance here. There was a little bit of imbalance here. Price rebalanced that. Okay, yeah, I'm happy with that so far. As for targets, still be targeting this high. That's a little bit of a more modest risk reward ratio, 7.57. Let's see what happens here. Ooh, would that be triggered in? Oh my gosh. Don't tell me. Yeah, hard to say. Hard to say. On TradingView, it shows that it's not tapped in. Right? We'd have to go a little bit higher. Literally a fraction of a pip. A fraction of a pip. So, I don't know. Technically, I do like to round the numbers, so I would go for 9.5 instead of 9.4. I like to go in proper increments when I'm placing my orders, but I don't know. This one's tricky. This one's tricky. I guess I'll include this one. Keep in mind, this is not a pre-planned video. This is a genuine backtesting session. These are trades that I would be taking in real time for sure. This is literally my thought process while I'm trading. So let's continue. So I forgot to mark out the breaks of structure. This is a proper break of structure to the upside. And it seems like we're going to get another one here. It's kind of early to tell as the stage price is in right now. Let's play price forward. Okay. I mean, that certainly is a break of structure, although it's kind of weak because we didn't have a full body closure. We kind of did, followed by some wicks. I am going to consider this a break of structure to the upside. But since it's kind of weak, I'm certainly not looking for any more scale-in opportunities. Let's continue. What's going to happen? Okay, just a lot of consolidation. Overall, it's pretty close though, pretty close to our take profit. Another very clear break of structure. Another break of structure here too. I'm not gonna annotate it really because it's just gonna get very cluttered here, but you can see that that's a clear break of structure. It even created some imbalance there. Okay, so that's really nice as well. Again, I'm not gonna scale into this because it's really late in the leg. I wouldn't get a good risk to reward ratio because this is my overall take profit, right? That ray line right there is my overall take profit. So if I were to enter a trade from, let's say here, I would get a very, very poor risk to reward ratio, probably like a 1 to 1.5 or so. That's pathetic. So I wouldn't be looking at that. Okay, let's see if this take profit gets hit. And it certainly does. Okay. Okay, interesting development here. So let's add this 7.5 as our third trade. Now, I actually hope I take some losses here just for the purpose of the video. You know, this is pretty good so far. We've got 1 loss and 2 pretty massive wins. So these 3 trades together, that's like, you could take the rest of the month off at that point. And we're only on the 1 minute time frame. So this is a very short period of time. This has only been 5 hours. It's only been 5 hours. So yeah, you could take the rest of the month off after a day like this. Okay, I do want to keep going though. So we've got this huge bullish impulse. So I'm going to delete this ray line now. It's obviously been violated. That high has been violated. Our take profit has been hit. So that's it for this position. Now, this is where a lot of people get confused, by the way, when it comes to locating the next possible entry. Obviously, bullish order flow is intact, right? This huge impulsive move tells us that clearly bullish order flow is still intact, but there's certainly nowhere to enter from yet. Why? Because we don't have a solidified high. From the looks of it, price is still going, okay? There's no solidified high, which means there's no pullback yet. If there's no pullback, there's no place for us to enter, sorry. So let's continue. Wow, went quite a bit higher. Okay, this is interesting. So I'm gonna mark out a ray line again. This is the high. That's certainly a solidified high. We've had a pullback. There's a few areas we could look to enter from. And I'm almost certain there's gonna be at least 1 loss here. But I'm okay with taking losses sometimes because the overall, like I'd prefer to take a few losses if it means having the opportunity to get into the move, okay? And as you can see with these types of risk to reward ratios, like, you know, 11.5, 7.5, little 1 hour losses are just pretty meaningless, to be honest. So if this zone gets induced, I would be looking at, this one's tricky. So technically it would be that candle right there. However, I'm going to target this entire consolidation. I'll drag that out. So the entire consolidation from the high wick to the low wick. And then we had a bit of a move on a much lower time frame. That would be another break of structure. And then we had this low momentum indecisional bullish candle. There's certainly demand in that area, but I'm going to target this overall area. So let's see. Now, mind you, if this is a poor risk to reward ratio, I'm going to disregard it completely. So we'll see what we can get. 3 pips would be really tight. I don't like to go that close to the zone. So I would be looking at, let's round it off to 4 pips. And targeting that high, that would only be a 3.5% trade. No, that's not good enough. So let's delete that. Not good enough. Okay, so this is our zone that we're going to be focusing on then. Let's see how this one plays out. if we get tapped in or not. I don't know. I'm not even going to place the position yet because I don't know if we're even going to get there. Okay. That is certainly a break of structure, but it could just be liquidity being purged from that area. So let's see what happens. Lots of consolidation here, very slow movement. What time is this? Yeah, that would be ending the New York session. Moving into Asia session. Okay, well, that is current price action. Okay. Well, as you can see, we didn't take very many losses. Now, this is something that could still play out in the near future. I'm going to leave that zone there, actually, for my own personal trading. But as you can see, losses don't really matter. Not in the mood to do this in my head. 11.5 plus, -1, and then plus 7.5. You know, you're at 18% if you're risking 1% capital, right? Again, I kind of wish I took more losses here to show you guys the real perspective of taking losses and then how one win can just completely wipe it out, right? But you can kind of get the point. Even if we, hypothetically, if we took another 1 hour loss and then another 1 hour loss and another, that, like, we'd still only be deducting 3 from that, right? You'd still be at 15%. You could literally take the rest of the month off and be completely further ahead than most other traders out there, right? So this is the true power of risk reward ratio and risking 1% capital. Now, if we were risking 0.5% capital, the R value stays the same, of course, but we'd divide this in 2. And still, 7.5%. If you're risking 0.5% capital, that's fantastic. Again, you could still just take the month off at that point, or keep going and hit that typical 10% target. Very manageable, right? But you know, keep in mind these 3 losses didn't even occur. So the power of risk reward ratio is phenomenal, right? This strategy, as you can see, we have very high risk reward ratio compared to most others that are targeting usually 3%, whereas we're targeting 5 to 10%, or sometimes higher, 20%. These trades are extremely powerful. And so you can see how this strategy can be utilized as well. Within this bullish leg, we took 3 highly probable trades. If we just even extended the stop loss to 3.5 pips here, or 4 pips just to round it out, we would have had another 8% tacked onto this, which would have been phenomenal. But just keeping it real, that did not happen. That was more than likely a loss on any brokerage account. This is the position size calculator that I use. It's located at myfxbook.com. You can find it in the menu up here, as well as an economic calendar and many other cool features. Now, the way I utilize this position size calculator is fairly simple. You've got the currency pair, you pick your currency pair, so let's go with Euro USD as the default. You pick your account currency. I'll keep it on USD, but you've got all the other ones as well. Account size, let's put 50,000. 50,000. Let's say we're risking 1% capital, and let's say our stop loss is 5 pips, okay? Trade size in lots, you just keep that the same. Click calculate, and it shows you. You should be trading with 10 lots on MetaTrader, okay? Some other platforms have, like execution platforms, have built-in position size calculators, and they do it for you. But if you're trading with MetaTrader, 5 or 4, go with this, or there's a few others out there. I'm not too aware of them because I've been using this for a very long time. I know there's mobile apps as well if you prefer to do it on your mobile device. But like I said, this is the one that I use, and it's very straightforward. Let's say I was risking 3 pips. Then I would type into MetaTrader 16.67 lots. I usually even round it down to account for spread or commission. So I'd probably go like 16 and a half or something, or maybe even just round it out to 16. Risk management is so important, guys. So please don't guess with it. Use a calculator. If your broker or execution platform doesn't already have one built in, use a position size calculator somewhere, okay? This is crucial. So I hope you guys enjoyed this lesson. I plead with you, please do not risk more than 1 to 2% capital. Even 2% to me is excessive. I never risk 2%. I'm happy risking 0.5%. So obviously a losing streak was not visible in this backtesting session, but this was a very real, genuine backtesting session, and these are just simply the results of that session. So I've incurred losing streaks before. I've had losing streaks of 5 to 10 trades in a row before. Mind you, these were during tumultuous times in my life. It doesn't necessarily reflect the strategy, but the point remains the same. My risk management kept me alive during that time, or during those times. It's happened a couple times. Because you can take multiple 1R losses. Let's say I took 10 1R losses in a row, and then I hit this one 11.5% trade. That one trade would wipe out 10 losses and still be net profitable by 1.5%. To me, that's mind-blowing, and I hope it's mind-blowing to you guys too, because that is a true example of why you don't need to risk 4%, 5%, 6% capital on every trade, shooting for the moon, hoping to get rich overnight. It's a very toxic mentality, and I know that, like we discussed previously, social media has blown that toxic mentality out of proportion in terms of all the influencers that promote it. Please be disciplined, treat trading as a business, and it will reward you as a profitable business, okay? I hope you guys really enjoyed this lesson and gained some value from it, and I will see you guys soon.